Hey there. So you've probably been wondering, how in the heck do you reduce your taxable income? Well, guess what? In this video, I'm going to be talking about Schedule A, Schedule C, and Schedule E. Everything you need to know to reduce your taxable income. Hold on, don't go nowhere, all right? So first of all, thank you all for jumping on today's quick webinar. I wanted to actually do this for my clients so that you guys are ready as we hop into this upcoming tax season. It's really here, but we'll just be waiting for documents to come in. But as we go through this last week of December, I want to make sure that if there's anything that you all can do to help defer income or to help you with your 2020 income tax return, you can take this last week to do that push, whether you're a business owner or whether you have some things that maybe you can move around. Maybe you can defer getting a bonus for anyone who's getting a bonus. Those types of things we'll be talking about. But I'll also go deep dive as much as I can, and I can talk just so you guys know. I want to talk about the different schedules that I typically see in the office and some of the hiccups that I see as information is filtered into the office. So I want all of you to be prepared when you do send your documents in, because as you know, this season, tax season, is going to be unusual from our other tax seasons. And I'll get into some of the things that will be different this tax season, okay? So let me go ahead and start my slide. So share my slide with you all. So we're going to jump right into things as we're getting ready for the tax season that's upcoming 2021. Some of the things that we are going to be discussing today, I'm going to talk about the importance of planning. I'm going to talk about standard deduction versus itemized deductions, Schedule A, Schedule C, Schedule E. And then I'm going to talk about record keeping, which is critical, which is vital, and that is why a lot of taxpayers find themselves in trouble. Number one, because they fail to keep good records. And then number two, either they don't keep them at all. And then I'm going to get into some other miscellaneous things that will be important for all of you as you prepare to get your documents into the office. All right. So a little bit about myself. You guys probably know much about me, a lot about me, but just so you know, I am the managing partner of My Financial Home. We've been in business since 2001. Of course, the name was changed a few years ago, but we've been actually operating, doing tax, bookkeeping. I don't even like the word bookkeeping. We do CFO services, accounting, and other business services for our clients. I enjoy all things business. You guys probably know that by now, finance, marketing, and I truly enjoy music and I love traveling. Unfortunately, I didn't get to do any traveling this year like most of us, but I didn't do any, not even like a road trip. So you guys can only imagine I'm waiting for things to get back to normal, just as many of us are. I've been consistently able to double my business year over year, thanks to my clients. And clients that have referred individuals to me, and just being able to give good value added quality information to my clients. And I think that's what's important, being able to give value added information to your clients that can help them make decisions in their business, personal decisions with their finance, and so on and so forth. In addition, I am a 6-time best-selling author. I've been on numerous TV shows, TV news stations, you name it, I've been on all of them probably. I have also had appearances in many of the publications. And the one thing that I always glean upon or like to say and share is that I was awarded the Lifetime Achievement Award by President Barack Obama. So just a little bit about me. I have 2 adult children. One's will be 30. I'm only 20, you guys. No, just kidding. But I have a 30-year-old and my son is 27. So that's a little bit about me, who I am, but have been running this business successfully for, it'll be 20 years, you guys, 20 years in 2021. I can't believe it. So let's talk, let's talk about, let me get it together. let's talk about planning. When we talk about planning, there's a difference in tax planning versus tax compliance. Being in compliance means that you are just filing your tax return. You're doing everything that the Internal Revenue says. You're doing everything that the various state agency says, meaning you're getting your W-2s, your 1099s, your 1099-Rs, your mortgage interest, etc. And you are filing an income tax return each and every year based on the due date and so on and so forth. That's great that you are remaining compliant. That's what the IRS and that's what the state agencies expect for us to do as taxpayers. But it's something called tax planning that is critical for all of us. And if we fail to plan, then our plan is going to fail, right? What's that saying? So I want all of you to get in a habit of making sure that you plan when it comes to your taxes. And what is it that I mean by that? Every year, all of us, including myself, we have life matters that happen. We have a change in our income. We have a change in maybe we've gotten married, maybe we've had children, maybe we've come into an inheritance. Any number of things could occur. And if we don't plan accordingly, then what typically happens is come tax time, as I like to say it, we're caught with our pants down. We're caught with surprises. We're caught with the unexpected to happen, and that means a huge tax bill. Now let me just tell you, I know for a fact because in 2018 I had a tax bill for the very first time. 2019 I had a tax bill, but no one wants to be hit with a tax bill, and especially if they're not anticipating it or they wasn't expecting it. So it's critical for each and every one of you to ensure that you take some time out of your days, out of your months, whenever, and make sure that you set aside time to give me a call, set up a strategy session so that we can have a temperature gauge as to what you can anticipate for the upcoming year. Now, I tell everybody, the last quarter of the year, that is typically the time you want to make sure that you get in. If you haven't got in mid-year, then you definitely want to ensure that October, November, and December, you make it a point to schedule some time to do some tax planning. It could be whether you defer your bonus, if you own a business, maybe the last month of the year, maybe you can defer income from coming in. What does that look like? Taking a little longer to invoice your clients so that the income doesn't come in the current year and it can come in the month of January. That's what we call deferred billing, so that the income is not reported in the current year. It's rolling over to the new year. Okay, so planning is critical. Make sure that all of you, no matter where you are in your life, you know, that you set aside some time to do some planning. Maybe you're approaching retirement age, retirement years. You want to know, what does that look like? How will it impact me if I still work, pull out Social Security, pull out some of my retirement? What does that look like? That's what I mean by planning, okay? And of course, for my business owners, you all know the rules. What does that look like? Do I need to pay estimated taxes? You know, do I need to convert from an LLC to an S Corp? What does that look like? You need to get in and have a strategy session. All right, enough said on that. Let's talk about Schedule A. This is an area where I see a lot of clients struggle with, especially since 2018. If you all recall, in 2018, they changed the standard deduction amount for us. So right now, standard deduction for single individuals is $12,400. For married filing jointly, it's $24,800. For qualified widower or head of household, I believe it's $18,360. Don't quote me, but it's $18,300 something. And then if someone decides that they're married and maybe they want to file a separate tax return, then they have the same standard deduction as a single individual, which is $12,400. So the reason why we're going to focus on Schedule A is because as a taxpayer, we have the option of taking our standard deduction, or we can take our itemized deductions. Now, because the tax law changed 2 years ago, and let me stop for a second because I forgot to tell you guys, if you have questions, just hold them to the end. You can put them in the chat. I will make sure that I get to them because I can't see the questions right now, but I will definitely get to them. Okay. So the tax law changed in 2018, which meant that a lot of taxpayers were knocked out of qualifying for Schedule A or itemized deductions. I'm going to go through all of the itemized deductions with you guys tonight very quickly so that you have an idea as to what is itemized deductions. Do I qualify for it or do I not qualify for it? Okay, but of course, you want to look at how much is your standard deduction and how much are your itemized deductions, and which one weighs, greater than the other. If your itemized deductions are more than your standard deduction, depending on your filing status, then of course, I'm going to take the itemized deductions for you. I'm not going to take your standard deduction because it's not going to do you any good, okay? My goal is to ensure that I minimize your tax liability and get you back as much as possible legally and ethically on your tax return, all right? So as we talk about a Schedule A, let's quickly go through the list. I'm going to go through it really quickly, so I need for you guys to write down these things. When we talk about the top portion of the list, we're talking about medical and dental expenses. We're talking about the co-payments when you go to Kaiser. We're talking about the dental work that you may have, whether it's teeth cleaning, whether it's implants, whether it's partials, whether it's whatever work you may need to go to the orthodontist for braces. You have a child, you have a dependent. The dependent must be on your return. If you pay for a child for braces, they must be on your return in order for you to take advantage of it, of the deduction. Okay, so just keep that in mind. So you want to just keep track of all of your itemized deductions as it relates to that particular category. Maybe you have crutches. Maybe you had a wig that needed to be made because of medical conditions and something was prescribed by your doctor. Those are the types of things that go under the medical and dental category. Now, we also have premiums where I see a lot of individuals who are in who may be getting Social Security, and so they have supplemental insurance. We put that in that category as well. But here's what I want for you all to remember, and this is what I want for you to write down on that sheet of paper. Remember, the first 7.5%, 7.5% of your adjusted gross income, the first 7.5% cannot be written off. So let's do the simple math on that. If someone has adjusted gross income of $100,000, that means that $7,500, the first $7,500 cannot be written off. So if your medical and dental, vision, and all of that was only $6,000, guess what? You're not going to see the benefit when we do itemized deductions, the first part on Schedule A. It will show a 0. But here's what I want you guys to know. I tell all of my clients, you just never know what happens in a year's time. Here we are in 2020. Several people may have been in the hospital. Several people may have had out-of-pocket expenses, despite the fact that we are in a global pandemic. So I tell everybody, keep track of all of your medical dental expenses because you just never know. One thing that I want you guys to be clear on, and I really need you to be clear on this. We get bills from our physicians, and a lot of times I think they're called POB or BOC, BOS. I don't remember what they're called, but they're basically a statement that shows what the total amount of the treatment was, what the responsibility of the insurance company was, and what's the patient's responsibility. I need for you guys to be clear on this. Just because you get that bill and it says your responsibility is $2,000, please do not bring that bill in here to my office unless you actually paid that $2,000. It's a red flag, because if the IRS audited you and you tried to use that as backup, guess what? That's not going to hold up with the Internal Revenue Service. Now, if you had that statement, you had a canceled check, you had a bank statement that showed that you paid the $2,000, that's a different story. That will definitely hold up with the Internal Revenue Service. But all the other stuff, the shenanigan stuff, it won't hold up, okay? So the other thing, track your miles. When you go to the dentist, when you go to the doctor, the optometrist, the therapist, all of those things, make sure you're tracking all of your miles as well, okay? And I just said the word therapist. You can write off any type of work where you're seeing a therapist. However, if it's work related, do not try to include that in. If it's workers' comp or something like that, let's not go there. That's paid for by the job, and we don't want to write that off and get in trouble. All right. So the next category is taxes. Let's talk about our taxes. We're talking about things such as sales tax. We're talking about our employee-related taxes in which we pay out of our paycheck. If you itemize, then some of those are a deduction on the Schedule A on your federal return. Our property taxes, which is the real estate that we pay on our home. The property taxes, our personal property taxes. Maybe we have jet skis. Maybe we have, it's not a maybe, those of us that have our vehicle. And for those of you that are in California, and I know this for a fact because I'm in California, but our DMV registration breaks it out line item by line item. And a lot of y'all try to slip in that you paid $300 for your DMV registration. Now, I'm not doubting the fact that you didn't pay the $300, but it is not the $300 that is the tax deduction. Let me say that again. It is not the $300 that is the tax deduction. If you look at your DMV registration really clearly, there's a line item on there that says this may be tax deductible. It may be $17, $47, $58, whatever, but it's a small amount of the $300. So when you guys bring those DMV registrations into the office, or this year when you upload them, because we're doing everything virtually, you want to make sure that you only pick up the amount that says this amount may be a write-off on your taxes. It says something like that, you know, not the whole $300, $500, whatever you may pay for your DMV registration. Now, in other states, it's a little different because a lot of the other states, believe it or not, they don't pay as much in registration as we do here in California. In Georgia, for example, I have a client, her registration for her vehicles are usually like $30, $40, you know, something minimal. And so we're writing off that full amount, okay? So we see things such as that. We see real estate, sales tax, and the sales tax is typically if someone buys an automobile and we pay sales tax on our automobile. So sometimes, and I won't know this, you guys, I really will not know this unless you tell me that you purchased a car and maybe we need to do a comparison. We need to look at what was the sales tax that you paid on the car versus how much you paid in state taxes from your paychecks, etc. Okay, and then we can do a comparison to see what's the greater advantage for you for your tax return. Otherwise, I will not know. All right. So what's next on that Schedule A? Next is interest, mortgage interest. So it's basically what it says. It's mortgage interest. It's the interest that you paid on your property. Your primary residence is what goes on Schedule A. Well, that's Schedule A. And then your points that you may have paid if you refinanced, or maybe you just bought a home for the first time and you paid points to reduce your interest rate, and also your mortgage interest, mortgage insurance premium. All of that falls into the category of interest on Schedule A. Okay, next category is charitable contributions. So the great thing about charitable contributions is, number one, you can write off as much as you can in household goods, clothing, things of that nature. It says if you do anything over $500, then we have to fill out another form. If you guys are donating a whole bunch of stuff, and just remember, this year, a lot of the donation centers were shut down due to COVID. They weren't taking a lot of stuff. So Don't try to fool a fool and put a whole bunch of stuff in that tax return, because the IRS knows these things, you guys. And you guys know I'm going to keep it real light. Don't play with the Internal Revenue Service. Do not play. Don't try to say you donated a whole bunch of stuff when in essence, number one, Salvation Army was closed the vast majority of the year, or whomever. Yes, they did reopen, but if you did do that, make sure you have the receipt to justify and support all the write-offs that you are trying to write off on Schedule A under charitable contributions. You need that slip from the agency. You need the amount that you donated, and it means the fair market value. Our fair market value is not the same fair market value as the Salvation Army, the thrift stores. As you guys know, those things that are in the thrift stores are drastically reduced. So just because you may have spent $3,000 on furniture, they're not going to sell that furniture for $3,000. They're not going to even sell it at what you probably would assess it for. It's drastically reduced. So make sure you do your homework before you just give me a number off the top of your head, because I'm going to question it. All right. Make sure you have the backup. I need to know what was the amount you paid, what was the date you gave it to Salvation Army, what was the date you originally purchased it, what was your purchase price, what was the fair market value price. I need all of those things should you decide that your charitable contributions, your non-cash, I'm talking about non-cash, your non-cash charitable contributions were in excess of $500. Okay. If you donated any type of monetary donations to Red Cross, United Way, whomever, then make sure you have a receipt to back it up. All right. Make sure you have either a canceled check. Make sure you have something where you swiped your debit card to show. Make sure you have a letter and something cross-references that says thanks for your contribution of whatever dollar amount that it was. Here's the deal, you guys. When we talk about charitable contributions, we're not talking about the kids that come to your door to sell the cookies. We're not talking about the girls and the Boy Scouts who are outside, out of the grocery store, selling the Girl Scout cookies, the Boy Scout popcorn. Those are not organizations in which we can write off donations. We're just helping the kids, okay? So let's get that straight. But we're talking about any type of organization that is a 501c3 organization. And you guys can always go to the Internal Revenue's website to determine if an organization is an active 501c3. All right. If you give something that's over $200, I think it's 200 or 250. Don't quote me. Just let's look that up. But the organization should be giving you back a receipt immediately, a letter. It's 250. Also, if you donate a car, then they will give you a form, and that means that I need to complete an additional form in your tax return. All right. So enough on that, charitable contributions. We have other miscellaneous deductions in which you can write off things, and they've watered that down so much, you guys. I would say just look up Schedule C in the other miscellaneous deduction category to see if it's something that you can write off. They've done away with all of our work-related expenses. We can no longer write off uniforms, union dues, professional dues, gifts, education, none of that stuff that we used to be in a position to write off if our employer did not reimburse us. So I don't know what all these people are going to do that have worked from home this year. They have not changed the tax law to benefit them. So at this point, you know, unless they do something within the next couple of days, which we know they're not, everybody is kind of at a loss. Okay. So that's enough about Schedule A. Just remember, when you bring your documents into me, I will take a look at what is the greatest advantage for you, the taxpayer, that will help you get as much back and reduce what you owe to Uncle Sam. I'm going to look at your standard deduction depending on your filing status, and I'm going to look at your itemized expenses that you present to me. All right. So let's jump into the next one, which is Schedule C. And I want to just give a quick overview of this because it does not pertain to all of my clients, but it pertains to quite a few of you. Okay. So Schedule C is for business owners. It's not for all business owners. It's for those that are sole proprietors, and it is for those that are a limited liability limited liability corporation, meaning they are a single member LLC. Okay, a single member, meaning it's just one person. This is not for a partnership. This is not for an S Corp. This is not for a C Corp. Those are other tax returns that we must do. What I want to say to anyone who is listening that is a client of My Financial Home, y'all, and I would say y'all, you all need to make sure that you capture your expenses and capture your income. Okay, if you have not maintained your records on an accounting software such as QuickBooks or a similar type of accounting software that captures your income and your expenses, then you need to go back and restructure all of your income. Okay, where did your income come from? Did it come from checks? Was it credit card? Was it PayPal? Was it Stripe? Was it Cash App? And let me tell you guys, Cash App is not a bank. Okay, Cash App is not some place where you should be having clients pay you. Yes, you can go in there and you can run a report, but that's not a true bank account, you guys. Okay, if you have to do Cash App, great, but make sure that you capture that in your income. The IRS states all income is reportable, all income is taxable. So if you are a business owner that has multiple areas in which your funds are coming into, you need to ensure that you capture all of them. Okay, you need to also make sure that if you are using a merchant account, you guys, and hear me very clearly on this, because I have someone that's being, I won't say they're being audited, because there is a difference between an audit and what we call a CP 2000 notice. A CP 2000 notice is when the IRS sends you notification that something appears to be wrong with your account, and they're giving you an opportunity to clear it up. Okay, it may mean, like I have a client now, it says our records indicate that we have these 1099Ks, 1099Ks that were not reported on your tax return. Well, guess what? They were reported in the tax return because we put that number under total income, but she did not bring in her 1099Ks to me, so I didn't put in the 1090Ks. The income matches, but the IRS is basically saying you reported this amount of money for income and we're showing it again. So they're trying to double dip. We had to justify why and how this $35,000 that was income on the tax return, Schedule C, was the same as the $35,000 that was on the 1099K. So if you do Stripe, if you will not necessarily, well, yes, Stripe, PayPal, any of those merchant accounts, make sure that you log in on the back end and get your 1099K. A lot of times they will not mail those to you guys. So just remember, Cozette said, log in on the back end and get the 1099K so that you have your year-to-date statement and you turn that in. Because I can guarantee you in the summer months, this year was in the fall, but in the fall or summer, when they start sending out those letters, you don't want to get one of those letters, okay? Your expenses, and let's back up to income. Make sure all of your income is total and is tabulated. And you guys, the main thing is that the income on all of these sources should somehow tie to your bank statement if you're putting the money in your bank, okay? If not, just make sure that it ties, because that's the number one thing that the IRS will ask for. Source of income. Let's see your bank statements for this period of time. You want to make sure that you don't have extra deposits in there. You want to make sure that whatever deposits that you have is what you're giving me. Okay, that's what you're giving me for your total income. All right, so let's talk about your expenses. I need for you guys to get better with your capturing your expenses. You got to get better at it, because a lot of times you guys just give me numbers that you think are the number. And when you give me those numbers, a lot of times I will question, like, where did this come from, or how did you derive at this? You guys need to spend some time between now and in January, because you're going to get your bank statement for the month of December, the second week of January at least. Take some time Download your year-to-date bank statement you can download it into a CRV file, CRV, CSV, Excel, something. Download it or take some time to go through your bank statement and make sure that you've captured all of your year-to-date expenses. You know, whether it's automobile, whether it's advertising, whether you pay somebody commission, you pay contractors. And if you pay contractors and you paid more than $600 to anybody, you guys should be issuing them a 1099. You really should be issuing them a 1099. 1099s are due January 31st, and the 1096 is due January 31st as well. They changed the date. So just remember, both of those are due at the end of January. But commissions, insurance, office expense, rent, rental equipment, travel, meals, automobiles, cell phone, any other training, professional dues, any other miscellaneous expenses, you want to ensure that you're capturing it all, and you want to make sure that you have backup to support everything. Here's where I'm going to tell you guys why I want you to have backup. And I see a question just popped up. Let me see if I can get it. Charitable contributions, do they count in addition to? So her question is, does charitable contributions count in addition to standard deduction? Those are two separate things, Dewana. They're two separate things. So standard deduction, and is 12.4 for you, and your itemized deductions must exceed the 12.4. So standard deductions charitable contributions are included in your itemized deductions on Schedule A. Okay, so they're two separate things. So for you, you just want everything to exceed 12.4, all your mortgage, all of your property tax, etc. One thing that I forgot to mention to you guys, on Schedule A under taxes, it's a cap of 10K. It doesn't matter if you paid mortgage interest of $15,000, $27,000. In that category in itself, the max is 10K. All right, so just remember that. I forgot to give you guys that tip. So back to Schedule C. Make sure, please, you guys, that you have all of your stuff reconciled. You have your numbers to the T. You know what they are, because the last thing that I hate to see is clients getting audited. Right now, I have someone being audited from their 2018 return. And I'm telling you guys, I've been doing this stuff long enough to be able to pinpoint and say, hey, this is going to cause a red flag, this is going to cause a red flag, and that's going to cause a red flag. I cannot tell you guys everything that I pinpointed in this client's 2018 return. I said to them, this looks suspicious, this looks suspicious, and this looks suspicious. I got backup for it. Some of it they said they couldn't find, but they had backup. Guess what? 3 weeks ago, they got a letter from the Internal Revenue Service, and they are being audited on the same exact things that I told them that did not look right for 2018. I said, these are going to be red flags because they're just all over the place this year. 2 of them, they said they had an enormous amount of travel. I mean, an enormous amount of travel. And based on their business, I said, hey, look, this is the type of business you're in. This is the normal travel for this business. Are you sure you did this much travel? Can I see a few receipts? They showed me a few. They said they had 34,000 miles in a automobile mileage. I question that. They reduced it, but guess what? That category still got flagged. So 3 areas that typically get flagged are your automobile, your meals, and your travel. So I forewarned the client. I had it in writing. I documented everything. We did adjust. They did show me some receipts, but right now they're in the midst of an audit for those 3 things. Okay. So I want you guys, if you put it on your return, if you put it on your organizer, make sure you have backup, because I will question. All right. So let's move on to Schedule E, which Schedule E is not applicable to all of my clients, but again, I wanted to just really touch the surface of it. Schedule E is typically if someone has royalties or if someone has rental property. Those are the 2 types of things that I typically see with my Schedule E. So if you have your rental property, Your royalties typically come to you on a 1099, but your rental property, make sure you know how much you collected in rent. That includes your deposits. If you took any deposits from your tenants, first month, last month, however it's being done, or if you have a property manager that manages things, make sure you give me that 1099, and there's a box on there that says rent. Make sure you capture all of everything that you can take advantage of. You know, the advertising, the travel, the legal, the repairs and maintenance, the depreciation, the mortgage interest, the property taxes, the utilities, anything that you could possibly think of that maybe you paid out of pocket for the rental property, you want to make sure that you include it. There is a cap on what we can write off due to passive income. So I always look at that when I'm doing Schedule E's, but I just really wanted to just touch bases on it, just really, really on the surface of things, okay? And if I'm going too fast, make sure you guys ask questions at the Q&A. I didn't want to keep you guys on here too long, but I wanted to make sure that I cover some of the things that I typically see that I see during tax time, that maybe I'm just, you know, going so fast, I may not get an opportunity to stop and say, hey, next year do this, next year do that, okay? So record keeping. Record keeping is so vital, you guys. I cannot stress this. Thank God that my client had all of their documents that's being audited right now. They do have documents to support the numbers in the tax return, which is a great thing. But a lot of times I see clients who don't keep sufficient backup. And I can tell when you guys are just giving me a number. And typically it's like, if I asked you for, you know, that you pay rent, you tell me it's $1,400. Any even numbers, you guys, is a red flag. If you give me like 1,400, anything that has all these zeros at the end, that's automatic red flag. And so when clients do that to me, I push it back and say, I can't take this. I need you to go back and redo this and give me true factual numbers. It may take a little longer to get this return done, but I can tell that you just pulled some numbers off the top of your head. And if I send this in like this, I'm setting myself up for failure. I'm setting you up for failure. And the one thing that, if you guys have been with me for any length of time, you know, I pride myself on not getting anyone in trouble, not being, you know, if I do something to one client, I know that it can have an effect on all of my clients. I don't want to see my clients in trouble. I don't want to see myself in trouble. So my thing is, if you give me something like that and I bounce it back, don't come at me with an attitude. Just be thankful that I'm trying to save you from a headache later on down the line. Go back, recapture things, and bring them back to me and say, I took a little bit more time, Cozette. Here's the numbers. You know, I spent 3, 4, 5 hours so that I'm not spending time on the back end if they decide to audit me. That's all I'm trying to prevent you guys from doing, is being red flagged. Okay. Record keeping, make sure you keep your records at least 3 years, okay? The IRS can go back up to 5 years or longer, believe me, should they choose to, and they will. But 3 to 5 years is typically the longest in which they will go back. If they go back 5 years, then typically they probably suspect something. And I have sat on a criminal matter case, you all, so they will go back further than 3 years if it is criminal negligence involved, okay? And criminal negligence is exactly what it says. You did something intentionally to defraud the government. And so thank God I was not involved in doing those tax returns, but I will say this, it's a hefty fine if the IRS determines that you are guilty of intentionally defrauding the government to get back money. You know, their penalty was, I believe, 75% penalty on the money that they owed. So let's look at it like this. If they were supposed to owe $20,000, they were doing it such that they were getting back $20,000. So you do the math. They got to pay back the $20,000 that they got, and they got to pay back the $20,000 that they should have owed, plus a 75% penalty. Then the IRS reports all that to the state agency, so they got to double dip. So it don't pay to, you know, defraud them. It really, really doesn't. So make sure you keep good record keeping. Make sure you keep it for at least 3 years. If there was a year where maybe something was unusual with your tax return, where maybe the income went up, shot up high, and so did your expenses, maybe keep that a little longer. And especially now, since we are in the midst of the pandemic, the Internal Revenue Service is behind, you guys. They are behind. They are probably a good 6 months, if not longer, behind. Seriously. So just know that they're behind. All right. So the next thing is audit protection plan. We do have audit protection plan, and I can't tell you guys why, but some of you opt out of it, and that's fine if you choose to opt out of it. But I cannot tell you, the ones that typically opt out of it are typically the ones where maybe they left something out, or they forgot to include unemployment, or just something, and they're typically audited. And if you forget to include income, that's not an audit. An audit is where you get a letter from the Internal Revenue Service, and it tells you to please contact us to make an appointment or to talk with an agent, and we need to see A, B, C, and D. Okay, that is typically an audit. Okay, when you get a notice, like I said earlier, CP 2000, that's just a notice saying our records reflect something different than what you reported. If it's true, then we will proceed and bill you. If it is not true, please provide us with backup to support the difference. Okay, there is a difference between the two. But our audit protection plan, and I'll go through it in a moment, of what it covers, you guys, is, to me, it's easy peasy, but I'm on the opposite side. I can only tell you guys and share with you guys the plans that we offer. If you opt out of them, then that's totally on you. But I always stress to everyone, just like my client that I'm dealing with right now, and they literally opted out. They checked the box that said opt out. And so when they got their audit work, I just said, not a problem. I am more than happy to assist you with your audit. However, you opted out of our audit protection plan. Therefore, I must bill you at my hourly bill rate. Okay. So the audit protection plan, and I'll go through it with you guys. Here's the audit protection plan. You have the basic plan, in which is $69.95. It's just basically going to cover if you get a correspondence from the IRS, like the CP 2000. I'll help you with one of those, and they're not going to send you more than one. The platinum correspondence, audit protection, and identity theft. And as you can, that's the platinum. And then as you can see, the diamond plan, what it covers. So I like to be clear when we talk about if someone is audited and what audit representation means. I've been saying for the last 10 minutes or so that I have a client that opted out of our audit protection plan. And so I had to bill them. And when I bill at a minimum of 10 hours, you all. So I say it's important that you grab these, but I also let you guys know, if I'm very confident in the work and I'm very confident in what you've provided me, then I will say, I don't think that this is going to be a red flag. But if I see that you guys have given me, and I hate to use this word, but I'm going to use it, some shenanigan stuff, and it just doesn't look right or smell right, number one, I'm going to question it. I'm going to question whether or not I should key that into the return. And hear me out, even if you've given me backup. I have a lady today, she sent me her tax return for 2019, and it had, I think it had $348,000 in, it had something. I don't even remember the category. I don't remember the category, but I asked for backup to support it. And her commission and her 1099 was high, and her foreign contract was high. And so before I put that in a return, I need to question it, because if I'm gonna promote and sell her the audit protection plan and I feel that she's gonna get audited, it doesn't make sense. So the audit protection plan is to help you guys in the event that you are audited, in the event that you get notices from the Internal Revenue Service. I do put stipulations on the audit. It depends on what type of audit. There are audits that require tons and tons of my time, and so this may be void and null. And then there are times where the audit is where the Internal Revenue Service it is an audit, but they're requesting that we provide backup to support some of the numbers that were in the return. So there is a huge difference, okay? But I just want to let you guys know that I do offer the audit protection plan. If you've been with me for any period of time, you know. If you've opted out or opted in, you know as well, okay? So next, this upcoming tax season, you guys got my email, my original email, and you got this email because you're on the webinar. But all appointments this upcoming tax season will be virtual tax appointments. As we all know, COVID is thriving and live, and it's unfortunate, but I've made it simple enough so that you all can upload your documents. Believe it or not, most of my clients are virtual, or have been virtual for years, but I do have clients that actually come into the office. Unfortunately, this year, I will not be seeing any clients actually in the office, not only for the protection of you, but also for the protection of my family members as well. And we just want to make sure everybody is safe. And this is really not 6 feet between where I sit and where my clients sit. So we just have to do things a little differently. And I think for the most part, you guys will probably enjoy it. And like I said, I don't have that many that come in. The only clients that typically come in are my clients that are here, right here in the community. They do come into the office and see me. And even it's gotten lately to where some of them are like, can we just drop it off? So with that being said, I do have drop-off hours where my clients, if you're in the area and you need to drop off, or maybe you can't upload, you can drop off your documents. And you guys can still, if you need to mail your documents in, I have provided the mailing address for you. You can definitely mail things into the office and they will get done as well. I've requested that you guys mail them to the, I've requested that you mail them to the home address and not so much the P.O. box. And the only reason why I did that is because I don't want to be going out to the post office every day to pick up mail. But that's the only reason why. So you guys can definitely mail them here to the house. If you want to mail them certified with their signature, by all means do that. My mailman comes at 6:30 anyway at night, literally 6:30, but you can definitely do that, okay? So with that being said, as far as the virtual appointments, what I have decided to do with you all is I will be doing a live, what happened? Okay, I will be doing a live demo for you guys with Onboardible. That's who I'm using this year, Onboardible, and it will allow you to upload all of your documents. It will allow you to answer all of your questions, the demographics, put your social security information in there, your date of birth, your driver's license information, your checking account information. And when we send the link to you guys, you will go in and set up your information for your account. You will set your account up for the very first time. That way you have full access to your password and your username. We have no clue what it is. All I ask is for all of you to ensure that you log that in a secured location so that I'm not inundated with calls like, can you reset me? Can you reset me? So make sure when you go in for the very first time that you set up a username and a password that you can remember. If you're married, tell your spouse what the username and the password is. But we will be doing a live demo. It may be this week, I'm not sure. I was gonna do Wednesday, but I know that's a short period of time. So I may have to do the following week when we come back from the holidays. But when we come back from the holidays, it's over for us. Everything's gonna hit. So at this time, what I would like to do, I'm going to take off a screen share. Yeah, I'm going to go ahead and take off a screen share and open up for any questions that you guys may have. If you ask a question and it's personal, I may say I'll reach out to you personally. If it is something that I don't know, then I don't have a problem saying, let me look that up and get back to you. So I'm gonna take this off of screen share. So I tell you what, if there are no further questions, what I'm gonna do is make sure that you all get a copy of these. If you do have questions later on tonight or in the upcoming days or whatever, feel free to shoot me a quick email. I will make sure that I address them. Just so you know, I will be out of the office from Wednesday until next week, returning on Monday, January 4th. So if I don't get to it before then just know I'll get to it when I'm back in the office on the 4th of January. All right. In the meantime, you guys, thank you so much for joining me for this year-end wrap-up. And hopefully you guys have a very safe rest of the year and a prosperous 2021. And I am looking forward to working with all of you. You guys have a great one. Take care. Bye-bye.